Hi, I'm Christine Benz from Morningstar.com. Not every worthwhile mutual fund has billions of dollars in assets. Joining me to discuss some of Morningstar's favorite funds that are relatively undiscovered is Shannon Zimmerman. He's Associate Director of Fund Analysis with Morningstar. Shannon, thank you so much for being here.
Good to be with you, Christine.
Shannon, let's start by discussing the premise here. Why do you even want to take a look at funds that have relatively smaller asset bases? What's the advantage of doing that?
So particularly among small cap funds, the managers are able to be more nimble in terms of entering and exiting positions. You think of a small cap manager trying to build a position in a small cap company. What's going to happen if they have a ton of assets as they're moving into a name is they're going to move the stock against the fund. They're going to raise the price as they build that position with a lot of money. And as they exit the position, they're going to push the price down because they're withdrawing a lot of money. A small cap manager with a reasonable size asset base is able to enter and exit a position largely at will without fear of moving the stock price against the fund.
So the big advantage is for smaller funds or funds that invest in less liquid assets where
Exactly.
That's potentially an issue.
Yeah, that's what we talk about when we use the term asset bloat, one of my favorite fund analysis terms. That's what we mean when a fund gets too big to move nimbly in and out of the kinds of names that it likes for the very reasons that you cite.
Okay, so let's talk about how the analyst team approaches ratings for these funds that you cover. You have a medal system
We do.
that you look at. Let's talk about what it takes to garner one of those high analyst ratings, either gold or silver or bronze.
Sure. Yeah, we have 5 ratings. There's gold, silver, bronze, neutral, and negative. And to garner a medal is a big thing. Even if it's a bronze medal, that's an endorsing notice on the part of the analyst, because that expresses the analyst's belief that over the course of the next market cycle of at least 5 years, the analyst believes that fund, bronze, silver, or gold, will be able to beat the typical fund in its category. So that's a pretty high level of conviction. And so from there, we look at the 5 analytical pillars. There's people, process, parent, price, and performance. And we rate each of those independently. Although, when you get right down to it, of course, there's cross-pollination across those pillars because one informs the other. But we rate each of those as discrete areas, and then those roll up to an overall analyst rating. And so the ones that we award medals to are the ones that we have the highest conviction in, bronze, silver, or gold. The funds that we're going to talk about today have all garnered nice analyst ratings, silver in 2 cases, bronze in 1, and not a lot of assets, which is somewhat surprising.
Okay, so in contrast with the star rating, which is backward-looking and looking at risk-reward profile, you're really trying to be forward-looking here.
That's right. What we like to say is that the analyst rating is an aptitude test. What is the fund capable of, whereas the star rating is an achievement test. What has the fund done?
Okay, so let's get right into some of these hidden gem funds. One of the first ones is a small cap fund, a small cap growth fund. It's Conestoga Small Cap. Let's talk about why the team likes that fund.
So that's a silver-rated fund with about $350 million in assets, which is quite small. Even for a small cap fund, it's quite small. And right, it's a silver-rated fund, has over the last 5 years annualized gain of about 8.2%, landed in the top quintile of the category, done quite well, but still hasn't garnered a ton of assets. We like it because it focuses on higher quality names that have track records of sustained profitability. So this is small cap growth, which can be a very volatile part of the market, nonetheless part of the market that many investors want to have exposure to. So personally, as an investor, that's the kind of fund I gravitate to in that space. And so what they do to have a hurdle for the kinds of companies that get into the portfolio is to focus on profitability in the form of return on equity, a good measure of a company's profitability. And whereas the Russell 2000 growth, which is this fund's benchmark, has about a 13% ROE right now, the fund is about 17%. Not huge, but in that not a huge differential.
So that's return on equity.
Exactly right. Again, a measure of profitability.
Right.
Not a huge differential, but big enough that it matters. And so the fund has a much higher quality tilt than the overall Russell 2000 growth. Performance has been strong. The managers have been at the helm since inception, and it's one of the funds that we like, even though it hasn't garnered a lot of assets. And given what we were saying before, that can make it an interesting fund to look at too, since it has all the other pillar powers in place.
So it also seems when a fund is small like this and it's focusing on small company stocks, it probably is a good indication that it can stick with small caps, that the manager won't have to graduate up and start buying Apple anytime soon, that it actually can stick with the smaller companies.
Excellent point, because a lot of folks want to be their own asset allocator. They don't want the fund to drift away from the area of the market where the managers have proven themselves, and that the person who's coming into the fund wants to have exposure to. A lot of times to contend with asset bloat, companies, rather than tightening the inflow spigot, they say no, we want to continue to get the flows because that helps them to garner more fees, and they'll go up the market cap ladder to accommodate more money when really that's not the manager's forte.
Right. The next fund that you want to talk about is a more value-leaning fund. It lands in our small blend category, but it does focus on small companies also. Let's talk about Berwyn Fund.
Berwyn Fund, yeah. So it does have that value orientation. About $360 million in assets, about $250 million in assets outside of the fund in separately managed accounts that are run according to the same strategy, but still quite small for a fund. This is also a silver-rated fund. It's in the small blend category. Moved out of the small value category, not because the managers have changed their stripes or are pursuing a different kind of strategy, but really because that's where they're finding the bargains. That the fund does have a quality tilt right now, but the value piece of it trumps the quality bias. Interestingly, and I think this will strike some folks who think, all right, this is a value fund, and maybe it has drifted into a blend territory. It still is unusual because technology is not typically a value haunt for portfolio managers, but in this fund's case, a substantial overweight, about 20 percentage points overweight versus the small blend norm in technology stocks right now. That's not because, again, they've changed their stripes or are pursuing a different strategy, but because they like healthy balance sheets right now relative to the company's prospects and certainly relative to the multiples.
Okay. I liked, Shannon, that you mentioned how much in other assets, non-mutual fund assets, these managers run. I'm guessing you would say that that's an important part of investors' due diligence process. Don't just say, this fund is small, ergo these managers are nimble. Sometimes that's not the case.
No, exactly right. So it's in fund assets, typically people think about the size of a fund, you're thinking about the fund's assets. But typically the SAI will list how much they manage in assets beyond the mutual fund. Now, you don't always know, are they managing those assets in the same strategy? But for small companies like this, it's sort of a safe assumption. Of course, you can always get on the phone and call them up or head to the Morningstar Analyst Report to find out more information about where the managers are managing money.
Okay, when you say SAI, that's Statement of Additional Information.
Yes, the most boring name of the most exciting document. It's where you can also find how much managers are invested in their funds too. Okay,
so the last fund you want to talk about is not a small cap fund, but it's nonetheless one that you think investors looking for quality large cap exposure should take a look at.
That's right. It's one that I cover. It's John Hancock, U.S. Global Leaders Growth, and I think that it's actually probably the best large cap fund that John Hancock has right now. Assets are under $1 billion in the fund. Now the firm behind it, the sub-advisor behind the fund that actually manages the money, they manage billions of dollars in this strategy outside of the fund. But the fund is still quite small for a large cap fund, about $890 million right now, so under $1 billion. And it's a concentrated fund, about 25 to 30 names typically in the portfolio. But given the area of the market that it focuses on, large cap growth stocks, liquidity is not really an issue. So there's no capacity constraints here to worry about. Over the long haul, tremendous track record using just as the shop does its SGA, Sustainable Growth Advisors. They do just this one strategy. They do this domestic flavor, and then there's an international fund that isn't run for John Hancock. They run it house branded, I guess you could say. Tremendous track record. One thing that I'll note about this fund is that it did well in both 2008 and 2009. And I think for investors that are trying to begin to research a fund, it's always interesting to see what funds did during those 2 years. Typically, funds that did well in 2008 didn't do so well in 2009 because
they're more defensive.
Exactly, sort of mirror image markets. This fund did well in both, and in talking with the managers there and then doing my own sort of Columbo work, why is that the case? And it turns out that they have a high quality bias, looking for companies that throw off plenty of free cash flow in a sustainable, consistent way. But it was the concentration of the fund that amplified returns in 2009, and it was the quality nature of the fund that served it so well in 2008. So a strong fund, like I say, probably the best large cap fund that John Hancock has in its lineup right now. Why is it only bronze? Bronze because the price is a little too high, moving in the wrong direction. So if the fund assets grow, presumably that price tag will come down, but right now it's about 12.3% for an expense ratio. Pretty pricey for a large cap fund.
One thing we've seen is that investors seem to have been strongly gravitating to index products and ETFs in that large cap space. What's the case for investing in an actively managed fund in the large cap space?
It's an excellent question. It's a question I keep asking my managers as well, because you look at these large cap companies and they're household names.
Right.
And they're widely covered. What cannot be known about them? And it all comes down to, I think, in most cases, valuation work. Are you buying them well? And it's hard to buy Johnson & Johnson well. It's hard to buy Apple well, right? But some shops have a tremendous track record of doing just that, and other shops don't. So it's possible to do it, but it's harder. It's very harder by far than in the mid-cap and small-cap arenas to succeed in an actively managed fund when so much is known about the companies that are in the portfolio.
So selectivity really matters.
It definitely does.
Okay, Shannon, thank you so much for being here.
My pleasure.
Thanks for watching. I'm Christine Benz from Morningstar.com.